For the California real estate exam, we're diving deep into the income approach to valuation, focusing on the math and formulas you must know. Let's start with the quick and simple valuation methods, the Gross Rent Multiplier and the Gross Income Multiplier. The exam will try to trick you based on the time period of the income. The Gross Rent Multiplier, or GRM, uses monthly rent, while the Gross Income Multiplier, or GIM, uses annual income. For example, if a property sells for $600,000 and has a gross monthly rent of $4,000, the GRM is $150. That's the price divided by the monthly rent. If the exam question asks for the GIM, you would first multiply that monthly rent by 12 to get an annual income of $48,000. Then, you divide the $600,000 price by the $48,000 annual income to get a GIM of 12.5. The most common trap is using annual income for a GRM calculation or monthly rent for a GIM calculation. Now, for the core of the income approach, net operating income and the capitalization rate. Net operating income, or NOI, is the property's income after paying all operating expenses. The formula starts with potential gross income, which is the maximum rent you could collect. Subtract an allowance for vacancy and collection losses to get the effective gross income. From there, you subtract the annual operating expenses to arrive at the NOI. The exam absolutely will test your knowledge of what counts as an operating expense. Operating expenses include things like property taxes, insurance, management fees, utilities, and regular maintenance. The biggest trap is to incorrectly include expenses like mortgage payments, which are called debt service, capital improvements like a new roof, or depreciation. These are not operating expenses and must be excluded from your NOI calculation. Once you have the NOI, you can determine the property's value using the capitalization rate, or cap rate. The cap rate is the rate of return an investor would expect on a property. The formula is value equals NOI divided by the cap rate. So, if a property has an NOI of $50,000 and the market cap rate is 5%, its value is $1 million. That's 50,000 divided by 0.05. A helpful mnemonic to remember this relationship is the IRV formula. Income equals rate times value. Think of it as a triangle. Cover the variable you need to find. To find value, cover V, and you're left with I over R, or income divided by rate. To find the rate, cover R, and you get I over V. This simple tool will save you from critical math errors under exam pressure. Remember, a lower cap rate implies a higher value and lower risk, while a higher cap rate suggests a lower value and higher risk. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.